Hello traders, Nick Shaheen here looking at Palantir. Relatively new stock to me. I have done videos on it before. They've been well received and pretty accurate, so it's time for an update. I may have done one last week, I cannot remember, but a lot has happened. So let's talk Turkey. Today is the 10th, February 10th. It fell about 6%, but this is a fast moving stock. The market had a tizzy, believe it or not. We had one almost red day. And people are freaking out. They're looking for headlines. What happened? I was like, what do you mean what happened? We had 6 or 7 up days. We can have a down day in the market. So nothing happened. Just price action. So speaking of price action, this has been great as far as price action. And maybe I should start with my conclusion. The conclusion is this is a really well trading stock. It gives us a good range. People can trade the ranges and then chase breakouts or breakdowns. In my opinion, it's easier to buy the dip or buy the rip in this one. So if the dip happens beyond the range, I would buy it to swing trade it up back into the upper ends of the range, and I would chase the breakout from the upper end. And I can even stay long it for a long time and keep selling shorter dated calls against it to make my asset put my asset to work. Disclosure: I'm currently not long the stock. I've edged out this. It whacked out everything. It gave me too much profit too quickly, and I was like, okay, so now I have to wait for a reset. And I think I have it. 2 candles I want to pay attention to is this one right here. This one gave me a nice range, which I did videos on to trade several times, and this white box. So we had the range between basically 22 and 30, but then within it there was a clear range between 25 and 28, and that sustained itself pretty wildly. Every dip into 25, I sold put spreads bullish at 25, collected about 25 cents with a total risk of 25 cents. You're poo-pooing that, but if I do 10, that's $250. If I do it 2-3 times a week, or 2 times a week, 4 times a month, it doesn't average out that I can do it 2 times a week because the market action doesn't work that way. But anyway, I did it several times. It pays the bills, so to speak, right? And then when the breakout happens, you can chase it. In this case, I use the breakouts to sell calls against my long call. And finally, I just got out of everything because this was just way too much. I don't remember where I got out, but it was a big burst, and I was like, beep, okay, I'll reset. Now, speaking of reset, let me take the noise out. So clearly we had one candle define a big range for such a long time, relatively. And then breakout from this level, tested the level with this candle, which I'm going to use for my next range. Slightly bigger than the other one, which I hate, but I'm pretty sure we can narrow the range down further next couple of weeks. So the idea now is that this is a new plateau because they failed, broke out, tested it, they could test it again. So earnings are coming next week, I believe, double check. That makes it a wild move. So it doesn't matter what kind of what shape the earnings are going to be in. In other words, the quality of the actual report doesn't concern me. Almost everything I read, beat this, beat that, beat this, beat that. It's what the expectations. You think you have an edge, you don't. It's a coin flip. The morning after is a complete coin flip as to which way they're going to move. I know you're skeptical about that, but if that's the case, the CEO will be able to tell you the night before the stock is going to go up, the stock is going to go down. They can't. So here's why. It's expectations. I know what I'm expecting from it. You know what you're expecting from it. I don't know what you're expecting from it, nor do you know what I'm expecting from it. Multiply that times millions of people trading it. Becomes a coin flip. Absolutely. The morning after reaction is a coin flip. The quality of the report matters in the long-term thesis. It doesn't matter as much it doesn't dictate as much the morning pop. So I cannot buy a share because I think they're going to blow out the earnings in a good way. That doesn't always happen. In fact, it's a coin flip. Anyway, so if it now the trading strategy was to buy it into 25 and double down into 22. Now it's try to buy it into 32, double down into the 28, the upper end of the old range into 30 or 28. What does this say? Credit put spread. So if it comes to 30, I'm not going to say I would love it to come to 30 because people are long it. But if it comes to 30, I would love to get long. So now is the do I buy it ahead of the earnings or not? How about a quick lesson on options? So disclosure, I don't have anything into it. I do have friends that just sold puts into it. So you're saying, oh my God, they're so reckless. Well, if you bought shares today at $36 a share, you're more reckless than they are. Yep. Let me walk you through the logic. So if you buy shares at 36 right now, you're spending $3,600, 100 shares, right? Out of pocket. You have no buffer. You're going into a wild event. So you're pretty much gambling for the next 7 days or next week or so. So 10 days. Can't count. So but I think they report sometime next week when this says 16th. Double check that. They're not always accurate. So you're on the hook right here, right now. If I, my friend, sold the $32 put and I collected $2, I'm making up that number. It should be close enough. But if I collected $2, then I'm committing to buy it at 32. By the way, this is not a trade recommendation. The only way I would sell a naked put is because I want to own the shares at 32. It's basically I'm saying to somebody out there, hey, I know you have shares. I know you're worried. Give me some money now and I'll commit. I'm locking in my purchase right now for 100 shares for one contract. So to open that trade, I would sell the put and collect $200. Yep. No money leaves my pocket. You spent $3,600 to be long at 36. I collected $200 to be long at 32. Who's more reckless? You or me? You are. Not in a bad way. You chose to be risky up here. I chose to be risky down here, and I chose to collect some money for that risk. No money out of pocket. Money goes into the account. So we wake up one day and the stock is at 30 between now and next Friday. If that doesn't happen by next Friday, I made $200 out of thin air. If it falls down there, that's 30. So you're down already 17, 18%. What am I down? Nothing. Because my P&L looks red as it's falling based on that one sold put. So the sold put will be down 100%. Who cares? My intention was to own the shares. So I'm waiting for it to hit 32, and I'm waiting to wake up owning 100 shares at 32. So if that person actually exercises, which by the way, they don't always do that, but if it's a short-term one, they're more likely to act. So I would wake up having 100 shares of Palantir at $32 cost, and the sold put position will disappear. The cash is mine. So now my break-even point is 30. So if we wake up and the stock is at 30, you're down 17%, I'm even. Which one is a better situation? The only difference is if the stock rallies, you're long and participating, and I'm not. I'm capped at $200 per contract. So that is the give back. So a combination of the two works. Some people like to sell the put and buy calls. This way they can participate on the upside and basically be long free. Plenty of strategies using options. So break away from the myth that options are dangerous always. They're not always dangerous. They can be dangerous. They move faster. They move way faster than equities. So in fact, actually, let's go to an options chain. This is Palantir trading account with practice trading account with E-Trade. I do not recommend this platform at all. It hasn't worked for me all week, actually 2 weeks now. In the morning, they say it's busy, and they actually told me I can go somewhere else. Like, all right, good to know. So it is at 35. It's down 6%, right? So if somebody bought calls, they're down like 30%. Because on the same day. So if somebody bought puts, they're up 50%. So they're juiced. They move faster. But when I'm selling, I don't need a rally to win. I just need price to stay above my strike price. Or if I want the shares, I'm hoping it falls into my strike price so I can get into my position. So yes, they can be risky, but they are not the deadly weapons that everybody makes them out to be. A little bit of education will get you away from the blanket idea of they're risky. Selling calls, oof, never. Because tell that to somebody who sold calls in GME. They are broke, absolutely broke. I don't care how big their account is, they're liquidated because nobody can withstand a loss in a call that they didn't cover from here to here. That was what, $20, $2, and up to 500 almost. there's no way to survive that. So margin calls would have come in if they had 3 days to cover that. If not, liquidation. So selling calls is definitely risky. I never do it. Never. If I want to short something, I'd sell a call spread. So let's say here I wanted to short GME and I sold a credit call spread where I sold a call and I bought a call above it. I usually collect some money, and if the price doesn't rally, I keep the money. But if the price rallies through that, I lose X, and that X is usually finite. And if I did that, then I'd be fine. I would have made a trade and I lost, as opposed to made a trade and I died, account-wise. So Palantir, great stock, great trading stock, good business, and there are a lot of fans out there and a few haters, but I think it's a good fight between bulls and bears, and it's been a fair fight so far. Nick signing out.